Hi, and welcome to the Michael Yardney podcast, where twice a week we dive deep into the world of property investment to bring you expert insights, practical advice, and everything you need to know before you sign on that dotted line. Now imagine you're at the doorstep, standing at the doorstep of your next potential investment. And now the property looks good, the facade looks good, the price seems right. But what else should you have thought of? What's lurking underneath? What questions should you be asking yourself to ensure the property will actually deliver the returns you're after? So whether it's your first investment or your 50th, the right question, I guess, can mean the difference between a gold mine and a money pit. So in today's episode, I'm joined by Brett Warren, and we're going to break down the 10 essential questions every property investor must ask before buying the next property. These are questions that could save you from costly mistakes and set you on the path to a prosperous property portfolio. So grab your notepads, because this is one episode you're not going to want to miss. So let's dive into it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Property investment can be an exciting way to build your assets, grow your wealth, increase your cash flow. But while many investors start out with the best intent, look, we know that only a few will ever make it to the top of the property investment ladder. So why is that? And it's really because they make the wrong decisions, they take the wrong turns. We know that 92% of investors never get past their first or second property. So to help you avoid the mistakes the vast majority of investors make, today I'm joined by Brett Warren, National Director of Metropole Property Strategists. And I'd like to discuss with him 10 questions you should ask yourself before you buy your first, or just as importantly, your next investment property. Hi, Brett.
Hi, Michael. Good to be with you. And yes, look, to avoid all that happening, I guess we've put together a list of the 10 most important questions any investor should ask before they buy their first property, or even their 5th, 6th or 10th property, I guess, Michael.
That's true, because it's really much the same. Even though the type of properties you buy may be different, you've still got to go through the same thought process.
Absolutely. Look, let's kick it off at the top with number one. We continually go on about this, but does this property you're looking at fit into your longer-term strategy?
Now, that's interesting, because most people don't even know what their long-term strategy is, do they?
I'd suggest 99% of the people we deal with and 99% of people out there probably don't, Michael. I think their strategy is actually buying the property, which, as we all know, is not a strategy. So do you have a plan in place if you're not ready to buy your next investment in property? Because it's really about that investment strategy is the first essential step on your property investment journey. You need to understand, and you need to have a proven roadmap. You need to have the frameworks in place to get to your destination. And look, at Metropole, that's exactly what we help our clients do. We help them develop a substantial retirement income in the future years and prepare for that retirement. And I often hear you talk about a cash machine, Michael, and our plan is always about, I guess, not looking short term, but looking longer term and outperforming the averages. We like to put strategies together that perform well over the longer term and create, I guess, what we call wealth-producing rates of return, which means we're avoiding the short term, we're avoiding the get-rich quick schemes. And in my experience, I guess it's like the tortoise and the hare, isn't it, Michael? Slow and steady really does win the race.
It does.
Yeah, look, I guess two great examples of that, Michael. I guess the first one, the long-term strategy we look for is buy and hold. And that's a very, very simple strategy. But the other one is, I guess, what you call BRRR or BRRR, buy, renovate, rent, refinance, and then repeat the process. So I guess the buy and hold strategy, Michael, it takes a lot of the risk out. It takes a lot of the guesswork. It takes out market cycles, because we're looking to allocate your resources and your capital into the best location and best area we can, and then hold it in that location for a very, very long time. And you and I have both used that strategy to create a lot of wealth. And I guess the next strategy up from that is the BRRR strategy, where we actually look to manufacture some growth. And I think that's something you can't do with any other asset. You can't add value to shares and money in the bank and things like that as well. But we've done simple renovations or cosmetic upgrades, and to the more, I guess, desirable things like you're doing at the moment, Michael, and I've done as well, is that property development where we can really fast track all of that. So I guess there's many stages your strategic plan should include, Michael. What are your thoughts?
Well, I guess let's just go back to that a moment. We've got a period of capital growth, but it's probably not going to be as strong as some people would like. We've had a good start to this cycle, but moving forward, capital growth may be in the order of 4, 5, 7% over the next year or two. In some areas better, others not as much. And if we can manufacture capital growth by doing renovations, that speeds up your returns. You get better rents, you get better leverage of your money. So we like that concept. Now, it doesn't suit everybody. And as you said a moment ago, also property development, where a lot of our clients become what we call armchair developers, where we buy an old house close to its use-by date in a good location and add value through getting development approvals and then eventually building 2 townhouses or 2 homes. Now, that doesn't suit everybody. Some people are currently getting an idea of, I'm going to buy cash flow properties, I'm going to buy commercial properties, I'm going to buy regional properties. It's all got to be part of the plan, as you said. And the sort of property that you should be buying should be suiting your current budgets. It should be suiting where you are in the game. If you're a beginner, you don't start off with property development. We don't recommend that at all. But buying something that you can renovate down the track, you may not have the budget to do it now, it gives you options as well. But it all falls back to having the right location, because if you do a renovation or a development in the wrong location, it doesn't help either. So as we started to say a moment ago, it's all got to be part of a plan. And that's just bringing your future into the present and doing something about it. And the plan, the strategy, isn't just, as you said, to buy a property or to do a development. Our plans, the strategy plans our clients get, have various stages to it. An asset accumulation strategy, a manufacturing capital growth strategy, just like we talked about, a rental growth strategy, asset protection, that's critical, and a form of tax minimisation strategy as well, doing that legally. A finance strategy. It's really interesting that over the last year, when interest rates went up and a lot of people are hurting because they weren't ready for it, I can't think of any of our clients, Brett, who had to sell because they had financial buffers in place. They had a finance strategy in place. And then in the end, it's how you're eventually going to live off your property portfolio strategy. But it's important to choose your strategy first, and then that's got to stop you making knee-jerk reactions. It's going to stop you doing the wrong things, and it's also going to help you to do the right things. So as we started to say, the 10 questions you should ask yourself, first one is, does this even fit in with my strategy? And I think we got a bit sidetracked talking about the strategy, but boy, that's a critical part.
Oh, look, and I think that's probably why we've got it as number one, Michael, to be honest. So,
yeah.
But look, I guess once you've got that plan in place, we always talk a lot about an investment-grade property. We've just experienced a once-in-a-generation boom where, I guess, fueled by low interest rates and pent-up demand and probably, excess spending that we'd normally travel overseas and spend things on, and it's been put into the property market. So every property has gone up in value, and I like to always say that everyone's a property expert at the moment because, as you said, almost every property's gone up around Australia at the moment. But that's going to be different moving forward, and not all properties make good investments or great investments, as we say. And I guess we probably think about 3 or 4% of properties on the market are what we would currently call investment grade. And I guess at the moment, Michael, with stock 25% down, that's probably closer to 2%.
In many ways, because people aren't selling their good properties. So you're right, Brett, there's not much stock, and in fact, not a lot of good stock at the moment. And because of that, well, I guess there's also a flight to quality. During that boom of a couple of years ago, when money was virtually given away for free, and that's what created that boom, FOMO kicked in and people were in such a hurry. They bought in secondary locations on main roads in regional areas. And some of those unfortunate lessons are coming to roost now. But currently, people are being more cautious, and that's good. And we're being particularly cautious about it. So what makes an investment grade property? Well, it starts with the location. You've got to have an investment grade location, one that's going to outperform the averages because of the demographics there, because of the wages there that people can afford to and are prepared to pay more. Their wages are going up more than the average for the state. And it's not just the people who live there. That's reasonably easy. We got deep research on that. You also want to understand who's moving into the area. The gentrification of the area makes a big difference, Brett.
Well, it certainly does. And some of the areas we're targeting specifically at the moment, those entry-level suburbs are where the retirees and lower socioeconomic are moving out of those locations. And, young families are coming in with double incomes, They're renovating, they're knocking things over. And that's critically important because if you're buying on the outskirts, unfortunately that type of demographic are probably living paycheck to paycheck. They've got high mortgage rates. And out that way, Michael, every property looks the same, doesn't it? So there's a real lack of inability to add value and create that extra things we're kind of talking about. So we look for the more, aspirational suburbs where people do have good incomes and their incomes are increasing. And Michael, we see it all the time, don't we? We're prepared to go up to a certain price, but someone's always willing to pay 50 or even 100 grand more because they get emotional and pay too much. And they're the type of locations we look for.
But it's also not just the owners in the area, Brett. I think it also means that the tenants who want to live there are not a week or two away from being broke like they are in other areas. Not all tenants rent because they're poor. It's something we bring up very often in our chats. And so we want the sort of, remember, your future income is going to be dependent upon your tenant's ability to keep paying rent. So in these areas that we're talking about having an investment grade property. We actually haven't even spoken about the property yet, but we're talking about the location where owner occupiers and tenants have got good incomes and likely to have increasing incomes over time. And I think the other thing COVID's taught us is the importance of neighbourhood, particularly in the southern states, not as much in Queensland where you weren't locked down as much, but people are working from home. There's more of that. So having a 20-minute neighbourhood, close proximity to shopping, to amenities, to parks, that makes a difference as well.
Well, it certainly does. I mean, I think when I was growing up, and probably when you were growing up, Michael, I was lucky to have one coffee shop around the corner.
What coffee shop? There weren't any when I grew up. There was a fish and chip shop and a Chinese restaurant.
There you go. But, I guess people, and I guess the next generation, and that's important to understand as well, because, they're reliant on those lifestyle precincts. They want that 20-minute neighbourhood. They want options. They want choices. And, they don't want to be living 30 minutes from a coffee shop. They want it all on their doorstep, and they're prepared to pay for it.
Sure. So as we're going through the list of questions you should ask yourself, we're asking, well, is it an investment grade property? So first of all, it was the location. Okay, what about the property? Okay, so now you've got a good location. What's the next step?
Yeah, you've got the right location, and now I guess we can get to the property, Michael. And once you've ticked all those boxes, we call it the top-down approach, and we keep working our way down. We're looking for one of those properties that outperform the averages over the longer term. So again, getting the best part in the best area. Will it, appeal to those owner-occupiers? They're the ones that are going to pay overs, and particularly tenants as well. They're willing to get emotional and, pay too much for a property. You're not looking for short-term profits because you want long-term averages. And if there are some things that you don't like or perceived, cosmetic things that you can change, that's a good thing as well, because I always say if you don't like something cosmetic or kitchen or bathroom, we can change that, but we can't change the location. We've also got to work out what the land to asset ratio is. Clearly, the higher the land to asset ratio, if you're spending $1 million on a property, you want the land value to be at least, $700,000 or $800,000 here in Brisbane if you're looking for a house. But also, if you're looking for an apartment, we don't want to, 300 in the complex where the land value's $50,000. We'd prefer to have a small B2 complex of 6 or 8. So that's critically important. And then, as I kind of just spoke about, the ability to manufacture growth. We can do some cosmetic facelifts. We can make a renovation, perhaps add a bedroom or a bathroom. And then, like we spoke about before, maybe looking at doing some kind of development as well. And finally, in order to determine whether the property is investment grade, you need to be confident you've done all of your due diligence on the property and make sure you've found out all the risks. And a great example here, Michael, is the flood risk. So the first thing our buyers agents do is a flood report before we even get out of our desk.
Sure. Also, if you're thinking of one day adding value, you can't just take into account what's happened up and down the street there. They may have done it under different circumstances where the rules were different. And I know in Brisbane, just certain houses you can't pull down, and there's some sides of the street where you can't develop. In Melbourne, similarly, there's zonings where you just go an extra couple of hundred metres or metre to down the street, and you've got different zonings in the same street. So as we're working through the list of questions you should ask yourself, is this part of my plan? Is this an investment grade property? And then I guess you've got to come down to, at some stage, thinking about the price. What's it worth?
Yeah. And again, looking at different areas and locations, and those outer areas, I guess in the house and land areas, the product there is so plentiful, it's always transacted. They all look the same, and it's very, very easy to determine a price. But I guess it's not like buying tomatoes or apples at a grocer, is it, Michael? Each property tends to have different features that make it unique. And certainly when you start moving into the inner to middle ring locations, you're starting to deal with properties that may be 70, 100 years old versus properties that have been built 2 or 3 years ago. So even houses side by side may have very different attributes and be very different types of properties. The land value may be worth more. Maybe there's some development aspect. Maybe one side of the street is in a school catchment. So it's really getting that perspective at ground level. And I guess that's what makes things so tricky. So there really is no right price, is there, Michael?
No, there isn't. Now, interestingly, tomorrow morning I'm bidding on an apartment for my nephew, Daniel. I haven't been to an auction for a while. The team normally does that, but he's looking. And there's lots of apartments. So in the area, nothing new. It's a great area of Melbourne that he's about to buy and for himself to live in. So I said to him, we've actually got to come up with 3 prices. The first price is, what do you want to pay? What would you like to pay? And obviously that's not what the property is worth. But okay, what do you want to pay, Daniel? Now, you've done a lot of homework. You've been to lots of inspections. What do you think the market value of the property is? And interestingly, it's considerably more than what the agents are saying it's going to go for. But he's learned that you don't have to believe, you shouldn't believe all that. And then I said to him, mate, you also got to give me one more price before I bid. What's the price you're prepared to pay? And let me walk away without you being disappointed on Monday, because I don't want you to think, gee, if I would have only got another 1,000 or 2, would have got it. So having said that, then there's not an exact price, and he's constrained by his budget. And my comment to him was that if you're constrained by your budget and somebody's got a deeper pocket, no matter how smarter a bidder I am, how strong and how much psychology I'm going to use, if somebody's got bigger pockets, the best techniques I've got aren't going to work. But actually having somebody who's experienced and confident on your side bidding, because poor guy's very nervous, I hope is going to tip the odds in his favour.
It also helps if you're, I guess, leaning on your Bentley as well, which I know is one of your...
Well, I often do that if it's outdoors. Here, it's actually in one of the inner suburbs of Melbourne and Windsor, a great location. So I think it's going to be done inside the property. So what I've decided to do was we worked out where the price range is, and we know that it's not going to sell in the price range that agent has recommended. So on that basis, what I've suggested is, look, if you could get it at a particular price, which is a bit higher than what the agent suggested, the advertised range for the auction, they've got to advertise that in Melbourne and say what they think. If I could get it at that price for you, would you be happy? And he said yes. And I said, well, that's going to be my opening bid. I'm going to open way above their range and put it on the market straight away. No, why would you do that? And I said, because I'm going to, just like you, scare the other people off as well. If you got it at that price, and they're not going to get on one bid, would you be happy? He said yes. And I said, so what we're going to do is I'm going to go in with my first bid, really strong, and open up and say to the agent, Ben, this is my offer. It's above the range, so therefore it's on the market now, isn't it? And by the way, it's my first bid. And by saying it's my first bid, I'm basically suggesting that I'm going to have others. And so there's a psychology at winning at auction. And I know that all our buyers agents at Metropole are experienced selling agents. And they know how to play the game. And it does tip the odds in the favour of our clients.
It does. And I know you've often scared even one of our finance strategists with those tactics, Michael, coming out of the blocks like that. But it certainly puts people on the back foot, especially if you're dealing with people who haven't bid at auction.
Yeah, because this is going to be mainly younger people like him.
That's right.
Except if they've got a dad or a mum with deeper pockets than poor Daniel's got. No matter how smart I am, it won't work. But so therefore, it was a bit of a sidetrack, but we have worked out what the price is by doing due diligence. And that's also difficult because you've got to understand why sometimes one side of the street is better than the other, or why one area, even though two properties look the same or in the same postcode, why one's worth more than others. What extra unique features has it got or hasn't it got, and how much do you add or detract from that? And that's where the perspective of somebody who's been in the market for a long time comes in and helps.
Yeah, I guess building upon that, Michael, something I heard which was really good, which you can't expect a first-rate return from a secondary property. So
No.
People are looking to focus on cheaper areas and cheaper properties. It's second place. You're playing the game, I guess you're not playing the game to win, you're playing the game not to lose by doing that. And you can't expect those higher wealth-producing rates of return. And look, on the other side of things, if you go to that auction, and I'd prefer to pay $50,000 too much for that particular property, Michael. If I knew in 10, 15, 20 years' time I was going to be $300,000 or $400,000 ahead, just because it's the best suburb and I'm buying the best property in the best street in that particular suburb, to give me those kinds of returns over the longer term.
Now, unfortunately, poor Daniel has missed the bottom of the market, and he was waiting. Again, young, inexperienced, and the concept was, when I know interest rates aren't going to keep going up anymore, when I know that everything's okay, we'll go ahead. I finally pushed him into actually doing and taking some action now, because if he keeps waiting, there'll always be reasons not to buy. And that's why it's good having somebody on your side giving you some confidence. Now, as we go through the list that you've given me of 10 questions you should ask yourself, I guess another question is, where am I getting my data, my information, my facts, my figures from? And in Daniel's case, he was starting to take it from the estate agent who, he's done some homework, he's gone to other open for inspections, and the agent has given him a list of comparable sales as they've got to, but he didn't have access to the industry databases that you and I have and the team at Metropole have. And it's interesting, this is a 5-year-old apartment in a reasonably large complex, but a really good location, and that's all he can afford. So therefore, it's not exactly what we'd call an investment grade property, but this is for him to start off and live in. I think he'll do well. And interestingly, we're very likely to be buying it for in the order of $75,000 less than the purchasers bought it 5 years ago. They probably bought it off the plan 7 years ago and settled in 2017 at what was a very expensive price. So the question is, where are you getting your data, your geographic information, your home, doing your homework? And there's a lot of information that you can get for free on the internet, but there's actually a lot more than that you need.
Well, there is, and I think going back to having a plan, there's also a plan when you're purchasing a property, isn't there? It's not starting with a property and reversing backwards to look for the right information and data to support your decision. It's actually starting from this end and the bottom end and looking at the area, the location, some of the top-down approaches we were discussing, and making sure you get that right.
So if you looked at the property I was maybe getting for Daniel tomorrow, you'd say, I wouldn't buy it. It's actually no good. It's gone down in value. Well, has it, or was it ever worth what people paid before? So what you've got to see is the history of the area and other comparables, not just that particular property, and what replacement value would be today. And you couldn't get it at that price again. No,
and look, if I was looking to invest for the next 20 years into a location, Michael, I wouldn't be looking at the last 4 or 5 years, because that's going to tell a great story. I'd want to understand the last 20 years, what's happened over that time frame. In that 20-year period, has it given the person above average rates of return? I guess what happens in downturns? Does the market recover, or does it lose a lot of value and take a long time to get back to where it was? So those kinds of things are really, really critical. And then I guess it's getting into the property-specific data and information as well around what it sold for previously, what similar properties are selling for. And we spoke before about getting advice, and I guess the last person you probably want to get advice from is the real estate agent. You're probably looking, and you need to have someone who's independent and is not tied to the property and can give you that independent viewpoint, and then back it up with data and facts and information as well.
Very much so. I guess the next question on the list is, do I have my finance pre-approved? And the answer is, in Daniel's case, for example, he has. He's gone to the bank, he's told them about the property. Now, you actually never get a total guaranteed pre-approval, do you, Brett?
No, you don't. It's very difficult, particularly at the moment. And as we've seen in the last 12 interest rate rises, it changed quite rapidly, and that can change from month to month. So I guess getting a really good idea and having a pre-approval in place is going to roughly give you an idea of how much you can spend. I think that's particularly important.
Yep.
An interest rate rise here or there will probably not change things in the short term, but getting a rough idea of where you are and what you can spend and making sure that you're not going to overspend, it's going to allow you to make a good, strong, firm offer on the property. As you said before, Michael, you can bid with confidence in that auction and start a good, strong opening bid knowing you've got finance behind you. You've got your repayments organised, you know what your cash flow is. I dare say our clients, and you're going to have a buffer in place that if interest rates go up or you have a tenancy vacancy, you can kind of cover that. I guess the process, sometimes you have shorter settlements. So if one step ahead, you can finance it and then get the loan organised quicker. I guess the best thing about it as well, Michael, there is some time involved in doing all of that, but it's really at no cost to you, is it?
No. So you need a good finance broker, finance strategist on your side, not go directly to the bank, and be wary of websites that offer you pre-approved home loans without taking into account all your financial situation. So getting a number off a website is not a pre-approval. And again, the pre-approval should come in the name of the purchasing entity. So Daniel buying something for himself to live in, it's going to be in his own name. But for a lot of our clients, they're buying their properties in trusts, in company trustees as trusts. And so therefore, some banks have different strategies, different loan-to-value ratios, different pre-approval levels for different entities. So check that. And also be careful with the pre-approval about whether the banks are prepared to lend on a particular type of property or in a particular suburb. At the moment, despite the shortage of properties, there are still some suburbs that are blacklisted by banks not being as keen to lend on. So that's again why, that's the stuff under the counter that you won't see and they won't tell you, why you really need a finance strategist on your side to have somebody who's got access to all the lenders. Interestingly, I think it's important that you have a finance strategy. That's part of the big strategy. But when we were talking about it, a finance strategy really hasn't got anything to do with, interest rates. That's not anywhere near the most important part, is it?
No, it's not. And I guess at number 6, while we're on that, let's discuss having a solid finance strategy, because many investors don't, do they?
No.
I guess, look, smart property investors use other people's money. They use leverage. So they put down a smaller deposit, and I think that's a great bit of a trick with property. You can leverage a lot more and use a lot of other people's money, the bank's money. They're using the tenants' money for income, so they're getting rental income on that, and we'd like to buy in areas where tenants' incomes and rents are actually rising faster. And finally, also understanding, I guess, what incentives there are from the government, the tax incentives. Maybe there's some negative gearing benefits
or depreciation allowance. Hey, so that's smart. So actually, as an investor, you're using other people's money in 3 ways: the banks, the tenants, and the government. I like that.
Well, that's right. You can't do that with a lot of other assets either, Michael. And that's why I guess people get into that kind of property. And, understanding all of that is critically important with, I guess, rising interest rates, unexpected expenses. We're in a high inflation environment. There's a lot of uncertainty around. So, even a 1% rise, as we're seeing, could make hundreds of dollars of difference in month each year, and thousands of dollars each year.
Yeah. Okay. So the other thing to understand is, in which entity should you buy the property? These are the questions you should be asking yourself, and you've got to do that in advance before you start looking. So if it's your own home, then most of the time you'd be buying it in your own name. There are some particular reasons why some professions won't buy a property in their own name. And I know our business partner, Ken Race in Metropole Wealth Advisory, still has a way for people who buy in a company or trust, getting some of the principal place of residence tax exemptions for a company, for a property not bought in their own name. That's a special strategy used for only a very small group of people. But make sure that you've got the right structure in place: your own name, in joint names, you and your partner, a trust structure, a company ownership. Now, the company is a separate entities from trusts, and while owning a property in a company definitely won't suit people because you don't get the capital gains tax exemption. For some people, and particularly for certain business owners, the lower tax rate of a company is an advantage. And then we're not allowed to give advice, so this is not a recommendation by any means. But for many people, I know you and I have properties in our self-managed super fund. It actually suits some of our clients, but you've got to get proper advice on that. But different ownership structures will suit different people, their different circumstances. So it's important to get the right advice. And actually, we have a service from the Ken Race and the team at Metropol's Wealth Advisory offer called a structure review, just to decide and help you decide how to make that decision. So if you go to metropol.com.au and just leave us your details, we'd be happy to have a chat about the right structures. Now, Brett, you've actually got a couple of more points I want to quickly discuss. I know that you look after, manage the national team at Metropol of the property strategists and the buyer's agents, and some people aren't even totally sure what we do. So maybe it's worth just mentioning that we're much more than just buyer's agents. We have a buyer's agency department, but I think the discussion we're having here shows that we start off with a strategic, holistic advice, and we don't sell property. That's one of the things we don't do. So if you are uncertain about how to take advantage of this new exciting stage of the property cycle, go to metropol.com.au and leave us your details. And Brett, while you don't see many clients anymore because you're busy running the businesses, I've stepped back in some ways. I know you still do see clients, and we start off by having a chat with you, working out where you are, obligation free, where you want to get to, what your timeframes are, what your risk profile is, and then if appropriate, and if we can work together, we'll let you know, and then we'll help you plan your future. And then, if it's what you want to, use our buyer's agency, property management, renovations, development services, wealth advisory. It's, as I said a moment ago, a holistic approach to getting outperforming the averages. And while we're a big company, we're big enough to swing the odds in your favour. As I think people are learning, Brett, you and I are still, and the other directors involved day to day, so we're still small enough to care.
We are, and we passionately do care. I think that's the good thing about all of the directors and the senior team, as well as all the other guys. We really care about helping people and making sure they get the right advice. We're passionate about it.
Okay, there's a few more questions on the list of the 10 questions you should ask yourself before buying the next property. What else is on your list?
Yeah, number 8 is obviously fairly, obvious at the moment and really popular is will my cash flow service my finance requirements? So, we've got rising interest rates and it's gone up quite substantially. But it's also important to understand all the different aspects of cash flow and understanding the income and also the expenses. A lot of people fail to understand that there may be additional expenses they haven't worked on. Maybe there's some depreciation they can claim to boost those types of things. But I guess the other thing as well, Michael, is cash flow is very, very important, and that's why you need to understand your cash flow. But you shouldn't target cash flow as an investment strategy. That should be an outcome, and whether a property is cash flow positive or cash flow negative is really got to do with finance and the way you finance it. And there's ways you can reduce the cash flow shortfalls as well. So it's really important you understand those figures, and you may need to work with an accountant, you may need to work with someone at a higher level, but I know that's part of the modelling and part of the plan we put together for our clients to ensure they understand that cash flow. Maybe they've got a buffer in place as well, and they can ride out those difficult times. Well,
cash flow keeps you in the game, but it's really capital growth that gets you out of the rat race. So for our clients, in general, the suggestion is to build your asset base so in the future you can buy as much cash flow as you like with your big property portfolio. Last couple of questions on this list of 10 questions, Brett.
Yes. Next one is we had a discussion with a client recently where the client said, I don't feel like I could live in the property. So I guess getting involved emotionally, Michael, is number 9, and that's something that you probably shouldn't do as an investor.
So your question is, am I really thinking like an investor, like a business person, or am I emotionally involved? Now, it's hard. It's exciting for people, especially the early purchasers. They spend a lot of time, effort, energy getting to the point where they're ready. But getting emotional about it leads to mistakes, doesn't it?
Yeah, it certainly does. And you've got to get back to the facts and the data that you're presented. And I guess that's your fallback position. There's certain things that you may not like about the property. As I explained before, you may not like the kitchen or the bathroom but most of the time you can kind of change those things. If there's something you don't like and you can't see yourself living in the property, I guess falling back on that data and information and the long-term fundamentals we spoke about will help close that gap and make it more of a head decision over a heart decision, Michael.
Now, of course, if you're buying your own home, 90% of your decision should be based on emotion. Well, a large part of it is, but the rest has got to be based on logic, because still for your own home, it's unlikely to be your forever home, so you should also think about it as an investment. And while we help a lot of investors buy their properties with our buyers agents, or on-the-ground buyers agents in Melbourne, Sydney and Brisbane, we have a separate team that helps homeowners, Leanne Spring manages that team of buyers agents. And yes, it's a very different process, but we actually have to help them remain emotional about the property they're going to live in. Their heart has to sing when they see it, but they can't be emotional in the negotiations, and they've actually got to leave that to somebody else. And that's, again, where our team brings an edge for them. So as an investor, though, no, leave your emotions out, leave the excitement out, make sure you've done all your due diligence. I guess the last question is an important one, Brett.
It is, Michael. It's what if my financial circumstances change? I feel a lot of people probably don't ask that question. It could be as simple as a job promotion, or I guess being made redundant. It's something unexpected. It could be, you're starting a family in a couple of years. There's things outside of your control that will change. So I always know that you say, Michael, that, I guess failing to plan is planning to fail. So it's really, really important that you ask that question of yourself: what will happen if things do change? Because the more you are prepared and the more planning you've done, I guess, to protect yourself and your investment, the more confident you can be in your financial circumstances if things do take a turn for the worst.
Well, that's right. So even though we help our clients plan, we tell them to plan for their plan, not to go to plan. And that's not necessarily a play on words, but it means that we also look for risks. And the risks occur in the market. The risks occur with your personal circumstances. As you said, what if your life circumstances change? And I guess the other risk is, the biggest risk is the one you don't think of. When you think you've got all your risks covered, something happens, like COVID, like 4% increase in interest rates, like a war overseas. And that's why plans should be flexible. And that's why we annually review our clients, or more often, to make sure that the plan is going to plan. And that's really where financial buffers come in place. And I have learned that lesson in the early 90s when interest rates went up and the value of my properties, because a lot of them were commercial, went down. And I got through it, but just. So I've always had buffers in place. And I thought I'd be using those up a couple of years ago during COVID when things were tough. Interestingly, my properties did well during COVID. The value of the properties went up. Our business did well. So you never know when you're going to need them. And then all of a sudden, despite me locking in interest rates, a third of my interest rates are not locked in. So I've needed the buffers over the last year or two. Who would have thought that interest rates would have gone up as much? So what if my financial circumstances change? Am I able to weather the storms and be prepared? That's a great list of questions. So let me quickly summarize those, and there will be a link in the show notes there. But the first question, Brett, you thought people should be asking themselves is, does it fit in with my long-term strategy? And I guess there's an underlying assumption that you actually do have a strategy, and more importantly, you have the right strategy. The next question then is this an investment grade property? And we discussed what that means. And we talked about what's it worth and how do you decide what a property is worth. And we came to the conclusion there isn't actually a right price, but you've got to do your homework and your due diligence and go in knowing that you're based on evidence, not on hope. The next point was, where do you get your data, your information, your facts, your figures from, and make sure that it's from reliable sources. Then we spent a bit of time talking about, is finance pre-approved? Do you have a solid finance strategy? The seventh question was, have you got the right ownership structures? Will your cash flow service the loans? Are you approaching this as an investor? Are you approaching it logically or emotionally? Don't get too emotionally involved. And the last thing is, beware of risks. What happens if your financial circumstances change? Brett, that's a great list of questions. And as you said right at the beginning, just as relevant for your 10th property as for your first.
Yeah, it is. And it's interesting to lay all those out, Michael, because we instinctively go through those with our clients in our sessions. So I thought it was a great opportunity to put it all down on paper and touch on some of those subjects. So I appreciate you running through those with me.
Fantastic. Well, thanks for your time, Brett. And if people want to actually do something about this, rather, you've missed the bottom of the cycle, but don't get caught napping with the market moving ahead of us now. Even if you're not ready to do something yet, if you want to see what the options are, what your possibilities are, I'll leave a link in the show notes, or just go to metropole.com.au. And as we said, we're much more than buyer's agents. We're big enough to make a difference, but still small enough to care. Thanks for your time, Brett.
Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share a lesson with you from my late mentor, Jim Rohn, who said that success is easy, but so is neglect. Now, he explained that people often asked him how over a 6-year period he became financially successful, while many people at the time didn't. And Jim's Rohn answer was, the answer is simple. The things I found easy to do, they found to be not easy to do, said Jim Rohn. He said, I found it easy to set goals that could change my life. They found it easy not to. I found it easy to read the books that had affected my thinking and my ideas. They found it easy not to. Jim Rohn said, I found it easy to attend the classes and the seminars and get around other successful people. And they said it probably wouldn't matter. So Jim Rohn said, if I had to sum it all up, I'd say that I found it easy to do, they found it easy not to do. And then he said 6 years later, he became a millionaire, and the others were still blaming the economy, the government, company policies, yet they neglected to do the basics, the easy things. Jim Rohn said, in fact, the primary reason most people don't do well, or don't do as well as they could or they should, can be summed up in one single word: neglect. It's not lack of money. The banks are full of money, said Jim Rohn. It's not lack of opportunity. Jim Rohn explained that as much of the free world is still continuing to offer the most unprecedented and abundant opportunities in the last 6,000 years of recorded history. Jim Rohn said it's not the lack of books. The libraries are full of books and they're free. It's not the schools. The classrooms are full of good teachers. We have plenty of ministers, leaders, counsellors and advisors. Jim Rohn said, everything we would ever need to become rich and powerful and sophisticated is within our reach. Well, today I'd be adding to that. There are podcasts and YouTube videos and blogs. Remember, Jim Rohn passed away a number of years ago, and he taught these lessons many, many years ago when I was just starting and learning to become financially independent. So Jim Rohn taught me that neglect is like an infection. He said, left unchecked, it'll spread throughout the entire system of disciplines and eventually lead to a complete breakdown of potentially joy-filled and prosperous human life. Jim Rohn said, not doing the things we know we should do causes us to feel guilty, and guilt leads to an erosion of self-confidence. And he said, as our self-confidence diminishes, so does the level of our activity. He was saying it's a downward spiral. And he said, as our activity diminishes, our results inevitably decline. And as our results suffer, our attitude begins to weaken. And as our attitude begins to slowly shift from positive to negative, our self-confidence diminishes even more. And it goes on and on. Well, Jim Rohn then said his suggestion is, when given a choice of easy to or easy not to, that you don't neglect to do the simple things. You don't neglect to do the basics, the easy, but potentially life-changing activities and disciplines. Now, that's a good lesson from Jim Rohn. In fact, you've often heard me say in these podcasts that you should do the hard things today to have an easy life later. But a lot of people choose to do the easy things now to have a hard life later. Well, that's almost the opposite of what Jim Rohn said, because he said do the easy things. But I guess successful people find those things that others find hard, they find them easy to do. They've learned delayed gratification. They understand that success is easy. You've just got to do what you've got to do to get there. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?